This presentation details the significance of the banking reform that was taking place in 2009. Specifically, it demonstrates what the impact of that reform will be on the balance sheets of the major banks in the United States. This presentation should be important to anyone who is currently invested in or interested in investments in the major banks within the country. This includes Wells Fargo, Citigroup, Bank of America, JP Morgan, and U.S. Bank, just to name a few. Although other reforms have already been proposed, the reform announced on November 12th, stating that banks would need customer consent to charge overdraft fees, was the most significant. This is going to adversely impact the earnings at these major banks in a substantial way. The impact of this legislation essentially dissolves the excess revenues that banks realized by reordering transactions. If you haven't researched this already, banks reorder your transactions from a chronological order to an order of from highest to lowest. Essentially, they do this because they are able to charge more overdraft fees as a result. With this new regulation, if you go to Starbucks in the morning and overdraw your account in the afternoon, you will not be charged an overdraft fee for that cup of coffee. This will start in July. In the past, the bank would simply reorder your transactions and charge you an excess overdraft. In doing so, banks earned billions of dollars in excess fees. The impact of this accounting procedure reduces state coffers. State tax revenues decline because of this. Think about it. First of all, individual bank accounts decline. Individuals don't have the money to spend at local small businesses. And therefore, the tax revenues that would be generated within the state from either sales tax or income tax or a combination of them both will not be realized. Instead, the money goes to the banks. I was asked to write a letter to Senator Dodd by one of my clients in June. I did so. The net effect is the rule we have seen passed and that will take effect in 2010. Let's use Wells Fargo as an example. First of all, banks do not disclose the number of overdrafts that they charge. Wells Fargo includes it in a line item. It's called service charges on deposit accounts. That line item includes checking account fees, savings account fees, bill pay fees, and overdraft fees. However, the checking, savings, and bill pay fees are generally waived. Before we take a look at the income statement, let's see how those are waived. Wells Fargo offers a variety of different checking accounts. All of them have a monthly service fee attached to them, unless certain criteria are met. Most often, that means direct deposit or a minimum balance, or automatic transfers to savings accounts. For the most part, most of Wells Fargo's checking accounts satisfy these requirements and do not generate monthly service fees. On the consolidated statement of income at Wells Fargo, you will find a line item for service charges on deposit accounts. Wells Fargo earned $3.19 billion from these charges in 2008. The next step is to determine how many accounts Wells Fargo has. From there, we can estimate the fees charged to those accounts. This information is almost impossible to find. You need to go inside the bank. From inside sources, I have discovered that Wells Fargo has, in total, about 17 million checking accounts. Most of these checking accounts do not get charged a fee. Instead, those fees are waived based on the criteria outlined in Wells Fargo's checking account agreements. Still, err on the side of caution. Assume 1/2 of these get charged an average fee of $8 per month. The math tells us that a total of $816 million would be attributable to this line item if that were true. After this generous observation, $2.37 billion would be attributable to overdrafts. The question is, how much of that is due to the excess overdraft fees resulting from the reordering of transactions? The example that I provided is not out of line. By reordering transactions, the banks generated multiple excess overdraft fees. Instead of one, for example, they would realize 4. This number is not out of line. Although customer service managers at Wells Fargo will verify that hundreds and hundreds of thousands of overdraft fees occur every day, and almost all of them are based on this reordering principle, I will be conservative and use a 3-to-1 ratio. Assume that 3 overdrafts are charged for every 1 legitimate charge. If that is true, Wells Fargo earns roughly $1.58 billion annually as a result of excess overdrafts. Go back to the income statement. This time, look at net income. These excess overdraft fees happen every year, and effectively, that will stop in 2010. That means if we adjust 2008 numbers, 60% of the revenues realized by Wells Fargo will be removed going forward. On a good year, 20%. That's a significant number. Wells Fargo currently trades with a 26 multiple. If annual revenue streams will be permanently reduced by the margins I have demonstrated, then that multiple needs to contract substantially. I expect it to. The law, announced in November, will have a significant impact. Banks have been allowed to prey on consumers for years. I'd like to think I played a role in helping change that. Now, consumers are going to have a little bit more money in their hands. With that money, maybe they'll use it to pay off their mortgages. And maybe that'll help us reduce foreclosure rates. Or maybe other bills can be paid and they can avoid bankruptcy. Or they can spend money at local small businesses and generate sales tax revenues and income tax revenues for the states in which they live. My estimates are much higher than what the federal government is estimating these overdrafts to be. However, I hope I have demonstrated here the significance of this regulation on the banks in our country. Although I expect this rule to alleviate some of the pressure on the consumers and help state governments realize more revenues, I also recognize that this is going to be a significant burden on financial stocks going forward. From here, I expect financial stocks to come under severe pressure. Go to Stock Traders Daily now to find out how we're taking advantage of that.